Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boycenow with my co-host Kevin Casey, who has finally returned from the great outdoors. Today we are joined by Brian Levy. How are you, sir?
Wonderful, wonderful. Always good to be with you guys. Enjoy this show immensely. A lot of fun.
My gosh. Okay, funny you say that because yesterday when we were talking, I thought you sounded a little grumpy about being here today. And I told Kevin, and as we were going through what the title should be, it was pretty fun. I mean, oh my God, Kevin and I go round and around on what the subject line should be, which is laughable because we never come up with anything particularly good. But he went rogue with, can we make regulation funny? Let's give it a try or something like that. I'm like, oh my God. So anyway, I'm glad you're happy to be here.
I was not grumpy yesterday. I was just trying to promote your thinking around why is it that you even want to have me on this
Why do I
show?
even want to have you?
Why?
Especially, okay,
We
here's
always question why people even listen to us.
okay. Okay, Brian, here's a question for you. So you're an attorney, you graduated from Harvard Law School, and now that Harvard's
Ay,
been canceled, are you still an attorney? That's what I want to know. Does your degree still count? Tell us about that, please.
It's still hanging on my wall. I'm still being asked to pay dues to the
Oh,
State Bar Association, both in Illinois and Wisconsin. Um, so I don't know. What does that tell you? Probably, yeah, I think
all
so.
right. Let's just assume you got one hell of a experience and a lot of good information at some point. Okay, so just for fun, it's jobs week. And tomorrow we have ADP. We're expecting, and we all know how this goes. It could go either way. We're expecting 115,000 job creations, and we will also get mortgage applications, ISM services, and Fed Beige Book. Thursday we'll have jobless claims. Friday we'll have BLS. Expect 130,000 or whatever number they pull out of their ear, which is, whatever. And they're expecting the unemployment rate to stay the same at 4.24%. The last I checked this morning, the 10-year treasury was at 4.46. So a little better than it was.
What is it now? 4 point what?
4.46. No? Okay. All right. Well, let's take a little dive into the JOLTS report that came out this morning because it's jobs week. Openings were up 191,000 to 7.39 million, which is almost 200,000 more than they thought it was going to be. The quits rate is down to 2%. So people are less confident in the economy. Any
Hmm.
comment? Any thoughts on how we're doing with jobs? What do you think the BLS jobs report is going to be? Come on, let's have some.
I think it's going to be down because I was surprised this in my own world. Last week, I had 3 people tell me that they got let go for quote unquote poor performance. And it was like, but they never told me what I was doing wrong. And it was without warning. It just suddenly, we're letting you go. And it was 2 people and within 2 days. It was like, wow, that's weirdly weird. That seemed to be a trend.
Well, okay, so they're in California, presumably, since you were talking to them. And
Hmm.
don't they have to be noticed? And aren't there all sorts of things that have to happen before you can fire someone?
Normally, but they can just say, hey, you know what? HR just started throwing things at, you know what? We decided to let you go.
Hey,
And
you guys got a lawyer on this show. Why don't you ask a lawyer that
yeah,
question?
that's a good question. What does the attorney
Oh,
think we should
why don't
do?
you ask a lawyer that's licensed in California,
I'm gonna say
which I'm
California
not.
employment law, go.
Yeah. No, I mean, look, California's got some of the most restrictive employment laws in the country. Everybody knows that. And it's not easy to fire people, or as easy to fire people in California as it is in most other states.
Well, one of these people was fired by a law firm, so you would think they would have their stuff
They
together.
might have their P's and Q's all straightened
Yeah.
out.
Well, they would at least think that they have the resources to defend against a lawsuit, right? Okay, let's start with some good news. We're still showing some positive home price appreciation. ICE came in at 2%, you're up 2% year over year, and Cotality is showing up 6/10 month over month and 2% year over year. It's kind of nice when they are sort of reflecting the same numbers and they're not completely out of line, right? So ICE also was talking about how the average consumer has $212,000 in tappable equity. That's 48 million homeowners with equity that you can get to. We have in the US $17.6 trillion in equity. That's up 4% from last year, another $690 billion. And that's 11 11.5% trillion, 11.5% trillion, $11.5 trillion available to borrow. So there are a lot of borrowers out there who are drowning in debt, and they are considering things like equity lines. Also, student loans after a 5-year pause, and I keep beating this to death simply because it is an opportunity for us. 20 to 25% of all student loans are more than 90 days past due. That's
Wait, repeat that number.
What was that number?
Yeah.
20 to 25% of people who have student loans are more than 90 days past due. More than, okay?
That's astonishing number.
It
Yeah,
is
that's
only, okay, listen to this. I put only in parentheses. 38% are in repayment or current. Isn't that and 10 million of the mortgage holders in the US have student loans. So if they are all of a sudden being told you need to pay that money back after 5 years, maybe they will consider disrupting their lower interest rate on their mortgage to do that. I think it's really interesting because it is going to impact things, especially because I just read too, I think that they're going to start taking like Social Security benefits away from people who have student loan delinquencies. Like you're not getting off the hook on this. That's the bottom line. So you definitely want to be in touch with your borrowers and let them know what their options are if you're looking for things to do. I also, just because I constantly talk about oil prices on here, and every time they tell me that oil prices are down at the pump, mine are up, and I pay really high gas prices here. And this time, guess what? Oil prices are up, my gas prices are down. I don't know why. I'm not calling the gas station this time to ask them, but holy guacamole. So, there you go. Also interesting to note that pending home sales in April during a very, very volatile stock market were down 6.3% month over month, and they're down 2.5% year over year. So I don't know if everyone else noticed April's home sales being a little wonky, but
I was the other way around.
tell us, Kevin.
Well, I don't know. I've had more purchases this month than in a while. So maybe I'm an anomaly, but heck, I'll take it.
You know, you're like you're the opposite of you're like my gas prices. You're the opposite of whatever the market is saying that it should be, right?
Yeah.
In other news, PCE numbers, the personal consumption expenditure for April came in better. They were about what was expected or a little better, but way better than we were thinking they were going to be, I think, a couple months ago. And also the run rates for the core PCE, which is important. So a few months ago, we were at 3.4% core PCE. Then we went down to 2.9. Now we're at 2.6%, which I'm really, really glad about. And the 3-month run rate is 2.7%. And a few months ago, it went from 4.2% to 3.5% to 2.7%. So it's moderating some, which is great. There you go. All right, Brian.
Don't ask me to make sense of all that data. They said there'd be no math.
I'm not asking you to do math. So, yeah. So I reserve the right to change my mind at any given point. Okay. So I wanted to ask you, because you are very deep into the weeds in the industry with all things regulatory and what's going on as far as compliance, et cetera, but you also are looking at things like what is going on with the GSEs. So what are your thoughts on, there's a lot of talk out there about, are the GSEs going to come out of conservatorship? What would that mean? Are the rates going to go up? Are they going to go down? And I'm hearing all sorts of conversations about this. Apparently, Pulte and President Trump are now saying that the implicit guarantee would stand, which would help interest rates not go through the roof.
Crazy, yeah.
Yeah, can you walk us through what's going on out there and your thoughts on all that?
Yeah. I mean, so I think the big sort of concern that the market has right now is that we've watched this administration take some precipitous kinds of actions. The tariffs are a perfect example. It just kind of, came down and then they were put on and taken off and lowered and increased. I mean, and really no rhyme or reason that we can really discern. Other actions, Doge, just slashing everything. It sort of is, the Chesterton fence issue. Why is that fence there? Before we knock it over, before we go around it, before we climb over it. Let's figure out why it's there. And then if we want to go around it, then we can. They don't really, they're more the, it's the progressive model of just, go around, go through it, don't worry about it, deal with the consequences later. So I think the market is very concerned about that kind of behavior in how it might impact the release of Fannie and Freddie from conservatorship, which they've been there for like 17 years. It's been,
Yeah.
I mean, it's been very, frankly, very stable during that time period. But back in the meltdown era, I mean, they were bankrupt essentially, and the government bailed them out along with a lot of other companies. So now they've been these government wards for this last 17 years, and it seems that it would be consistent with the Trump sort of model with the current people that he's got in place, particularly Mark Calabria, who was FHA director during the first Trump term, who really wanted to get them out of conservatorship back then, but wanted to do it in an orderly fashion, wanted them to build up their capital so that they could support these guarantees in the market. The secondary market really depends on, you got to remember, 95+% of the mortgage market runs through Fannie, Freddie, and FHA.
Is that still true, Brian? Is it still 95%?
Yeah, the CFPB just did a study like a year and a half ago, and it was even higher, I think, I mean, 96, 97. I mean, non-QM is certainly viable and becoming more viable. And frankly, that's what I wanted to talk about was that, folks need to have a plan, I think, for, well, what happens if this release from conservatorship is not orderly? That it happens precipitously, as we've seen other things. And, what are your, and it doesn't have to be non-QM, because now we're talking about sort of formally conforming loans. How are you going to source the secondary market for those? Now, if your audience is mostly brokers, that's more of a problem for the wholesalers to figure out. And those folks tend to be my clients or the big retail mortgage bankers. Where are they going to sell their loans, and what are they going to do with the servicing? I mean, if you don't have a sort of a backup plan, or at least a thought of how quickly you can pivot, because if they just, sell Fannie and Freddie, just, we're gonna collect a couple $100 billion selling these to BlackRock or to Citadel or some, massive fund that can afford to buy them and then to be the guarantor. I think everyone pretty much understands that if you have a private company, even with a rock solid balance sheet, that it's just not the federal government's balance sheet. It doesn't back it up in the same way. You guys talked about the implicit guarantee. That's what we've been living under, except it was made explicit, right? Because they actually did step in and guarantee all that debt in the meltdown. And I'm not sure, I'm sitting here as a lawyer saying, I'm not sure what the difference between an implicit guarantee is and a explicit guarantee, other than, well, maybe we reserve the right to not actually do it the next time, which is a little bit
like a Lehman Brothers and great disaster.
Yeah, I mean, it was interesting. That's a good point, because like they didn't bail out everybody, right?
Right. But when they didn't, it made it worse. Like if they had bailed out Lehman, things would have been a whole lot better than not bailing out Lehman.
Right.
Because once Lehman
I
went down,
tend to agree with
everything
that.
else went.
I think they should have, essentially bailed out everybody in the mortgage business and then dealt with that. I mean, the banks with the TARP, they paid that all back.
Yeah.
And, they took no losses on the TARP.
Well, yeah. And then look recently, with First Republic and Silicon Valley Bank, when they weren't supposed to bail them out exactly, but they still did, even though it cost billions, it probably saved billions, because otherwise it would have been just a whole plethora of other banks suddenly going down. And, sometimes it's like you just got to stop the flow.
Yeah. So anyway, all I'm saying is that I think folks need to be thinking about that. What are they going to do if this happens and it's not, a 2.5 year transition for us to slowly digest it?
I think that I'm so mixed on this at this point because I had, after lockdown and the CARES Act, I was so concerned about this shift towards the private sector carrying a lot of the load with regards to mortgage, and the GSEs having been the only thing that was stable through the CARES Act and lockdown, when everything just was like it just was like a tidal wave all over the place in every segment of our business. And so I was like, okay, GSEs are really important because they're the stable one during a crisis. And but at this point, I'm like, they have made themselves so expensive in a lot of ways. And as Director Pulte keeps talking about being concerned about credit report fees, which we all are, he's not, I haven't heard him talk about the LLPAs, which are really what's driving the cost in the GSEs. And the fact that they're making huge profits hand over fist. I mean, when the whole rest of the industry was just suffering the last 2.5 years, and every quarter they're showing big profits. Okay, so at what point do we address that? And then they're talking about, cutting away the fat from the obese Fannie Freddie, but how are they doing that? And then how is that actually translating to the borrower? Anyway, it is complicated, and I would be shocked right now if that number was still 95% of the market. I thought anyway, I'd be curious to see what the more recent numbers are. I've actually asked a few times recently because the last few years as non-QM has grown in not just popularity, but it's become a real resource for a lot of us when the GSEs just don't fit the bill. And that happens pretty darn regularly. I just keep wondering, like, how important are they? And other than the stability during a crisis, I don't know what the answer is
Well,
really. I'd be curious from our audience what they're doing.
Well, let me address the question that you're raising is what should be the federal government policy in supporting housing finance? I mean, that's the multi-trillion-dollar question that we've punted on for 17 years. Congress remember we had the patch, and it was supposed to be, they had 7 years to figure out what was going to happen with Fannie and Freddie. That we just blew through that. Nobody did anything. Then they came up with a new QM formula. The idea that the government can use housing finance to as a leverage to achieve housing policy goals certainly is very much diminished if you take Fannie and Freddie out of the equation and put them into the private sector. Your concerns about loan level pricing adjustments, I mean, if you're in the private sector, you're making loan level pricing adjustments. You don't care that, well, it's inequitable, right? You're just trying to make a profit. And if somebody's a higher risk, you're going to charge a higher premium for that, higher interest
Whoa,
rate.
wait. You said that someone's a
That's
higher
happening with
risk, you charge a
GSEs.
higher premium? Don't you need to give them people who are higher risk a lower interest rate because they just can't get by in life?
Right. So that's my point, Kevin, is that if you are if you're and frankly, that's how the FHFA was run during the Biden
Yeah.
administration was the goal, the housing goal, if you will, wasn't to create more housing opportunities for everybody. It was to create a more equal distribution of housing opportunities, which isn't the same thing. We can all, either, grow the pie or we can all share a limited pie. I think growing the pie is probably a better idea for policymakers. And then we still have something to do. Look, capitalism, it's like, it's the best thing that's ever happened to reduce poverty that's ever been invented. But there's always some people that are going to lag at the bottom. There's going to be some people that don't get, the tide doesn't lift them. And I think there's a certain level of discomfort, certainly that I have personally with leaving those people behind and not having something available for them. You know, but the question is what? And um, I think those are two separate things. One is enhancing the market, enhancing opportunities for everybody, and the other is addressing the problems at the margins.
I think that I know we've talked about this quite a bit on here. We have FHA and they always had expanded guidelines. And it's interesting because their delinquency levels have really risen in recent months. They've moderated a little bit recently, but it is interesting when the loan level price adjusters were adjusted, where they really favored people. They took it, there's no way that this is all based on risk. Let me just bottom line what I say, because the algorithms I've asked for, I don't know, a decade for the GSEs to show me their algorithms that show that it's more risky on a cash out refinance at 20% loan to value than for an 80% purchase. I mean, show me that those loans are more delinquent when at 20%, yet we still have a loan level price adjuster. So, and we could go through the grid and say that over and over again. Okay, you're telling me that someone with an 800 credit score is going to get a worse price than somebody with a, anyway, it drives me crazy. And if they were just honest and said, listen, we're just socking it to you at the higher end because you think you can afford it and we're trying to help the other people. Okay, that'd be one thing, but they're trying to sell this as something else. And I just think overall, when you start to price out loans and you look at those loan level price adjustments and they stack on top of each other, it's egregious. And then you've got the G fees, you've got all these fees, and then they're talking about the cost of a credit report, which again needs to be addressed, because why are they 4 bazillion% higher than they were a few years ago? But I think that we're missing the point in some of this, which is, if we are here to serve the consumer, which in theory we should be, even though the main objective in the mortgage industry in recent history has been, let's go IPO, everyone has to have huge gains month over month, you've got to, more money, more money, more money to the people at the top, and the borrower gets lost, and I don't like it. And so it is, I don't know, I'm frustrated, obviously. And so it will be interesting to see what shakes down in the future. But I will say that I think that the way forward is, make sure that you are really aware of all the options that are out there with non-QM. And there are lenders where you can do either a 1 year, a 0 prepay, you can buy down prepays. That really, for me, is often the only barrier for, like if somebody wants to refinance soon or whatever. So anyway, bottom line is, let me bottom line this. I think there's a lot of work to be done, and I'm concerned that it's not going to happen for the consumer. It's going to happen for people who are already making more money than anyone else in the industry.
Yeah, listen, I think some people think that Fannie and Freddie should be a housing utility, a financing utility that you can go to, like you can get your, electricity from your utility company, you can get your mortgage financing from a government-sponsored financer, and that everyone is entitled to that loan, just for being, a human being that wants to buy a house. These underwriting requirements, they don't matter. Everyone should get a loan, and then if they don't pay it back, they lose the house. I'm not in favor of that, and certainly that's not how the GSEs were set up by Congress. But nobody's, when I say nobody, I'm talking about our government, which should be the legislative branch. This has not done anything to decide what housing policy should be at the federal level. So they've left a void. They've left it up to the president, essentially, the executive branch, to make decisions, and that's what we're getting. And unfortunately, I think this particular executive branch tends to make precipitous decisions, and worry about the consequences later. So I think that's what I'm worried about with Fannie and Freddie, I think the longer this drags out, I think the more likely it is it's going to be an orderly exit. I think, Calabria certainly is very involved, and he has no desire to just press the launch button. He wants to do it the right way. And I think there's other people in the administration
Good
that
thing.
feel that way, but I just don't know where it's going to end up. But let me also say non-QM, you keep referring to non-QM, but I think there's private label securities that are not necessarily non-QM. They may be QM. And that's essentially
I
what
think
Fannie and Freddie would be if they were privatized.
I think part of the reason why the numbers for Fannie and Freddie are so high in FHA as a percentage of all the loans is because the banks are not lending their own money these days. That they've kind of exited that market, and that all those jumbo loans that Chase and Wells and all those guys were doing, that was taking a big chunk of the market, and that's gone. And until it comes back, we're going to see, Fannie, Freddie.
Who's doing jumbos now?
Yeah,
Well,
very few.
Scott Besson is talking about the fact that that will probably benefit the banks when we have this bank deregulation that's happening. They're going to be able to be a bigger part of the market, which could be a good thing or a bad thing for us as brokers, right? And Brian, back to your point, I don't think anyone's entitled to anything, other than a fair rate and cost. And I do think that companies are more than entitled to making a profit. That is not the issue. The question is how much of a profit and when is enough enough? So again, back to Fannie Freddie for the last 2.5 years, as you're watching most of the other segments of the mortgage industry just suck wind, and they are posting billions and billions in profits month over month. That's my issue on the backs of the homeowner. That's where that's happening. And so anyway, it is, in our industry, orderly is always better and less volatility is always better, whether it comes to the markets and rates or, any kind of change. So hopefully this will happen at some sort of measured pace. I think the messaging, even though they're talking about doing this, have also said there are other things that are going to happen first. So maybe we do have some time to, have the market digest all this and figure out a good way forward so that there is still a place for I don't know. It's just so complicated. You just can't come up with some
Let me just slightly disagree with you here. But as government sponsored entities, the question of how much profit they should make is a valid one. But also keep in mind that to the extent that they are essentially owned by the government, all of their profits are going back into the treasury, which in theory goes to all the taxpayers, which is all of us, even non-homeowners. So essentially, we have to remember that the GSEs are subsidized by the US taxpayers at the end of the day. That guarantee, that implicit or whatever guarantee, is provided by the US taxpayers, and the US government, because we're the ones that have to basically support it, right? So I don't know. I mean, it puts them in a very odd position when they're in a profit-making mode and they're also owned by the government. I think it's odd. We've been living with it for a long time, though. So here we are.
If the government has made more in profit than they cost them to pull the GSEs out of bankruptcy back in 2008, isn't it time that they just, okay, now we've got our money back?
Well, think of this as like I saw somewhere in the chat, somebody was talking about how some of these companies in the meltdown were sold for pennies on the dollar, but they were sold because somebody took a risk,
Yep.
right? That they would make money in the future in those brands and in those companies. And frankly, the US government bought out these companies in bankruptcy, and they are entitled to the fruits of of their future profits from having bailed them out. I don't think it's like, well, it cost them, 500 million to bail them out, but now they're worth 500 billion, and we could,
Right.
like, I think we keep the 500 billion, for the government, for the people. Now what we do with the 500 billion, that's where the,
Well,
Trump
I
wants to
hate to
buy
tell you this,
Greenland,
Brian.
like,
I'm pretty
I
sure
wanted
that
to
500
reduce
billion
the
has already
debt.
been, I'm pretty sure the 500 billion's already been spent.
Well, in a big, beautiful bill, it might be, but I haven't seen that.
Okay, so again, I don't think anyone well, not anyone. I don't think that there are entitlements necessarily. I think we just have to find some sort of balance, which is not something that anyone is very good at. Because if you think about it, if we're critical of this administration for going too far one way, the other administration could be accused of going too far the other way. And
Absolutely.
we never end up in the middle, and the pendulum never settles in a balanced area. It's always swinging wildly, which is one of my big concerns for our industry. Is it's so politicized at this point, and so we have these wild swings, which takes me to the next thing that I wanted to talk to you, which is we have a CFPB that has been really, let's go with
Got it?
kneecapped, since the other word in my head is going to cause all sorts of problems anyway. So, and thank you, because I was going to sit down this week and read the 96-page year-end report from the CFPB. And when you're like, I said, do you want to talk about that? You're like, no, it's looking backwards. Who cares? It's over. I'm like, all right, fair enough. That is a fairly decent assessment of the situation, and I will save myself. I don't know how long that would have taken. So, but with that being said, you as an attorney in this space, you have people who come to you and say, "What about doing this? How about doing that?" So, will you walk us through what the sense is out in the industry and what's happening with innovation and the risk rewards associated with that?
Yeah, great question. Um, so first of all, despite all of the, chainsaw imagery that you may have seen, the CFPB still exists. Pretty much all of the laws that they have implemented, have developed. The congressional laws are certainly all in place. RESPA, TILA, your basics. In fact, the law that created the CFPB is still in place. So all of these things are still there. It's just that maybe now they're going to be enforced and interpreted differently. Maybe we'll see some congressional action. Again, that's where it should happen. The question of, to your point about this whipsaw issue back and forth, that's because Congress is not debating, deliberating, and compromising the way that the body was intended to do things. They're just sort of abdicating to either the executive branch and hoping the judiciary stops them if they go too far. And really, we should be voting the bums out of office because they're not doing their job. Their job, but I mean, that's very unrealistic too, because this is sort of the dynamic we have today. So anyway, what this creates, I think, is even though it doesn't mean that you can, just ignore compliance, forget regulation. It's a free for all. It's the Wild West. That's not the case at all. I mean, first of all, again, the laws are still in place for the most part, and we've got state attorney generals who are becoming very active. States sometimes have their own mini CFPBs, California, Pennsylvania.
Yep.
Others are looking at something similar. So I'm not at all suggesting that to be lawless, but I am suggesting that this CFPB was very preemptive in terms of how it would view different ideas, and it would be very restrictive. If you would ask them, well, is this okay or is that okay? They'd be very worried about, well, what is the disparate impact of this? Does it have any kind of discriminatory impact? Does it have any kind of relation to truth in lending that is not properly disclosed? They look for a reason to say no to everything. And I think they're certainly not in that mode today. They're probably not in the mode to even look at whatever you're, suggesting. So I do think that there are opportunities in the market to design consumer-friendly, well disclosed, products and services, financial products and services that meet consumers' needs that maybe aren't, falling into the sort of the traditional 30-year fixed, mortgage trade disclosed kind of financing product. And I'm seeing a lot of that from different quarters, frankly, and helping folks navigate how to best do that.
So is that to say that we can look forward to some new products, some new underwriting guidelines? Like, how will that translate for us and our borrowers?
Yeah, I mean, so for example, I've worked with somebody who's got tenant in common financing. So, reducing down payment needs of borrowers through tenant in common financing. Um, Talking to help folks develop a product based on a ground lease, a financeable ground lease, as opposed to a mortgage product. There's just all kinds of different ideas that will enable different borrowers, different credit perspectives, different credit files, essentially, to be able to obtain loans or obtain homes through financing.
So we are going to have this DFPI, which is the Department of Financial DFP Protection and Innovation in California. So one of the two regulatory agencies on. We're going to have them on in a couple of weeks. I asked to have the director or one of those guys on, and they can't right now because they're so busy getting everything situated, ready, all this stuff. So I'm going to have somebody else on in the interim. Then we'll have them on in a few months because, again, they're talking to other regulatory agencies across the country to see what everyone else is doing. So when I talk to the heads of these agencies, they're able to speak to some of what's happening in the rest of the country. So I find it interesting. And they want to talk about some of the scams that are out there too. And this is one, just to throw this in there, that I saw that I'd never heard of. Is so egregious. I can't even believe it. So it was posted on somewhere. It said, I received an email from a friend today that was an invite to her celebration of life. I was shocked. I saw her earlier this year. She's one of the most healthy, fit persons I've known. I called her and she's fine. Don't click on anything. So again, like, okay, so somebody's trying to scam you, telling you your friend is dead. Can you freaking believe that? Anyway, so I just thought I'd throw that out there as things you want to be aware of when you are navigating all this, and things to share with your borrowers so that they can be on the lookout for it too. Another thing that's happened, because I've been talking to a number of realtors this week, and it is interesting out there with the realtors right now. Kevin, I don't know what you're seeing too. And Brian, do you work with realtors or talk to them at all?
Sure.
Okay, so there has been, at least in some markets, I can't speak for all of them, but there has been a shift where there are some realtors who really just think they can stay at home and do everything on their computer. They don't want to get in their car. They don't want to go to broker tour. They don't want to go. They really want the borrower to advocate for themselves. So I would say that if you are working with realtors who are doing this, maybe you as the LO could, get them going a little bit, because the borrowers need more than that. That's, I mean,
I haven't seen that.
we really need to go old school in a lot of ways in this industry. We've tried to do everything tech. It's not working. I even saw a posting from someone this morning. They're really talking about a world where we don't exist at all. It's all done by AI. And I'm like, okay. I mean, that, good grief. With that being said, on the flip side of that, for the people who are doing mortgages and real estate, I would caution you to be careful, because I read this online too. The seller's agent was a new realtor for about a year, but he also has his MLO license. During my process, this agent friend tried calling my lender to get info on the loan I was doing for my buyers. Then he tried to convince my realtor, who happened to be this person's father, to let him do the loan. So, and he goes, idiot, because he had no clue of my relationship with the buyer's agent, that he was telling me all this backhanded stuff he was doing. Needless to say, our buyers found that seller's agent's actions to be very unethical. So again, if you don't try and take someone else's business, like, focus on your own business and do the right thing. I'm just blown away by this stuff. And I'm like, why?
Do you remember my comment when UWM came out with their loan estimate AI that would analyze a competitor's loan estimate and tell you how to come up with a cheaper way of presenting the deal to them? And do you remember my response to that? It's like, what the hell, people? Go get your own loans. Don't be run around trying to steal other people's loans. You all know how hard it is to get these loans, and then these people just want to go around and steal the, oh, you're in process where you're talking to somebody else, oh, well, let me see if I can steal it from them. It's like,
Okay. No, go ahead. Sorry.
well, I'm just saying, I just don't like that. I mean, I remember the scenario of the three mortgage companies were golfing, or four mortgage companies, and they were talking about the trigger leads. And so these three bankers, or there's four of them total, and the trigger leads came up, and one of the golfers goes, "Oh yeah, we get like 96% of our business from trigger leads," and the other three golfers just basically shut him off, didn't want to talk to him the rest of the golf tournament or the rounds. And it's like, yeah, you're not, go find another way of getting business other than stealing it.
Well, okay, I thought this was interesting because there was a, a shift away from what has been statistically consistent in recent history, which is, for the most part, servicers have not retained much of the servicing when people go to refinance. So it was somewhere in the range of 17 to 20% from the numbers I was seeing for a really long time. Then when we had that little mini refinance boom in September, October, that changed and they were retaining a lot more of the business, which was that was interesting, right? But now we're back down to they're retaining, we are 2/3 of the consumers were either very likely or extremely likely to use their most recent mortgage broker that they'd used. And 77% of consumers were only considering one or two lenders. And so again, I don't know. So, and that kind of jives with when I listen to one of these the biggest mortgage lenders in the country speak, and they basically, the messaging was, hey, we take in a tremendous number of loan applications. We throw it all against the wall, and if 30 to 40% of it funds, great. And the rest of it, they don't even bother with it. And I've talked about this before. I have a friend working at a bank. He will not even work with a borrower who doesn't have 20% down and is a W-2 salaried employee. I mean, there is a limit to what a lot of lenders out there will do and banks will do. They want to cherry pick the things that are the easiest. And those of us who are in the weeds, we know everything's rough right now. It's tough. There's very little of that paper vanilla, which is why, Brian, when we're talking about percentage of GSE business, I'm like, holy crap. And Nelson said he thinks that the number he's seen recent is more like 70% of the business going to the GSEs. I thought I'd seen 80%. So I think that probably has come down in the last couple of years since that last report. But
Maybe that's why you should read the CFPB report.
I guess
See what it says.
I'll scan it, see if it's in there. That's so funny. Anyway, I just think, okay, so here is another thing. This is according to ICE. The top reasons renters aren't buying. How about this? First of all, can't afford to buy. 2, they're happy renting. 3, haven't saved enough for a down payment. 4, rates. So only 8% thought they could buy for 5% down or less. Only 8%. That means our messaging is not getting through to people, right? Like the fact that there are so many other alternatives. A third think you need more than 20% to buy a house. And finding a good deal is the reason they'd buy instead of rent. And I think, again, I keep harping on this too. They can't afford to buy. Well, okay, maybe you can't afford $1,000 car payment times 2 and eating out every night of the week. So again, I think part of it is lifestyle, but that's a whole nother thing, which I don't know how much we can affect change there, but maybe pointing out that, hey, we have very different expectations today for the conveniences and the luxuries that we want to have in our lives versus 20 years ago or 30 years ago or 50 years ago, right? Or even 10 years ago, probably. So, yeah, interesting, right? But on the list of reasons they aren't buying, rates are on there, but insurance, that's not on there. Property taxes, not on there. You know, things that are actually huge, even bigger than rates in a lot of cases, right?
I think the big one is job security.
That is a big one right now. I mean, people are, okay,
That is really the biggest one right now.
it is big. Okay, funny you say that. So, hang on, I have something on this. Shit, where is it? Oh, good grief. Okay.
Well, while
Five,
you're
oh,
doing that, I would contend that the meltdown was as much a problem of jobs as it was of, just bad underwriting, bad loans being made. Because the music stopped when unemployment started to go up.
Yep.
That's when it was unsupportable. I mean, we had unemployment at close to 10 or 11%, I think, at
Yeah.
the peak. I mean, and that's just not sustainable for, certainly, people making their monthly payments.
Right. But a lot of that unemployment was coming because the mortgage world kind of came to an end and housing starts stopped and, purchases stopped
Yeah,
and
there's a chicken and egg issue
construction
there too, for
stopped.
sure.
oh, okay. If we're really keeping it real, we went from you didn't have to have a job or verify anything to buy as many houses as you wanted for whatever, down payment you desired. So we went from that to terrible unemployment. And so anyway, I mean, the ability to repay was a game changer for sure.
I
Although
totally
I
agree.
would I would say that it could use a little tweaking, and I think that's what non-QM does. It's tweaked some of that so that people who don't fit into that traditional little Fannie Freddie GSE box, which is teensy tiny and has not been changed in forever, they have options now, which I freaking love. I love it. So
Yeah,
again,
let's talk about ability to repay for a second, because I mean, I rail against regulation and, stupid regulations like LO comp. But ATR was probably the best thing to come out of Dodd-Frank,
Mhm.
by far. I mean, it basically keeps the mortgage industry from racing to the bottom and doing exactly what you said about, making loans to people just that, on the basis that they can fog a mirror. The I mean, it's terrible that we had to make underwriting a law,
Yeah.
that we had to actually say, well, we have to check and see if you can afford this loan before we're going to give it to you.
Right.
But that, I think, unfortunately, was something that time has shown that we needed as an industry. And so I'm in favor of that. And QM's, you're right, it's just a small box of ATR, but ATR says you just have to prove out that this person has a reasonable ability to repay this loan over the life of the loan.
Yeah.
And you've got
So
to be able to document that.
yeah,
when I
I
started,
remember when it first came into effect and yet the ability to pay, and I had people that had, $1 million in the bank and they were trying to borrow $200,000 and the lenders are saying, no, you can't
right.
borrow the money because they don't have the ability to pay. I'm like, well, they have $1 million in the bank. They could pay the loan off tomorrow. Oh, we can't use that. And it was like, this doesn't
Well,
make
that's a
any sense.
misread of ATR, frankly. I mean, if you can do an asset depletion
Yeah,
loan,
you can
and
now. At first you
that,
couldn't.
oh
Now you
yeah, but
did
the industry, that was why we had QM, was because the industry was like, well, how do we know if they have a reasonable ability? We need a safe harbor. We need a safe harbor, and that was what all the discussion was back then about QM. But
Yeah,
QM is a safe harbor. ATR doesn't. All you need is to be able to show the reasonable basis,
right.
and that's where non-QM has really flourished.
I think what I think part of the issue, I bet there are a number of people on here that did loans in the late 80s. Like I started in the business in 1989. At that point, we didn't have credit scoring that we were using in the mortgage space. You get a credit report, you could look at it and you would say, okay, they're paying their bills, or oh, they had one late. Here, we can explain that away. It was fine. And I always had a conversation about payment and can you pay? Can you, how much, what else is going on in your life? I always did that. Then credit scoring happened, and it was a slow progression towards, hey, if they've got a good credit score, then it's fine, anything goes. And that's part of how we ended up in the meltdown just a few years later, after credit scoring, because they were so dependent on, oh, you have an 800 credit score. And I'd look at a credit report, I'm like, yeah, you have an 800 credit score, but you have $125,000 in revolving debt. Maybe you should go pay that off or do something about that before you buy a house, or right? And people didn't want to listen. I mean, I gave great freaking advice, and there were some people who listened, and some people are like, I'm going to do it
And
anyway.
that's still the case, Audrey.
Yeah, exactly. But the point is, like the credit scoring can be very misleading. It does not necessarily mean, I mean, because a lot of us get that feeling in the pit of our stomach about whether someone is a good risk or not. And it's very hard to quantify, but I mean, I don't think I've ever been wrong. Like I've never had a bad feeling or a good feeling for someone
Well,
who defaulted.
you know what doesn't matter to ATR?
The pit,
Credit.
the feeling in the pit of my
Credit score.
stomach.
Credit
What?
score
Yeah,
or
credit
LTV.
score.
Credit
Oh,
score and LTV do not matter.
Yeah.
The test is, look,
I know.
we shouldn't put anybody into a loan in which they can't succeed, right?
No,
They should be able to succeed. Now, events may happen, divorce or job loss or whatever, those things can impact your ability to succeed, but they may be unpredictable. But if they need the ability to succeed in a loan, and frankly, I think we found out in a big way that when you make a home loan in this country, that um, you can't say, well, this borrower really wanted it, and they qualified, so I gave them the loan. You're not going to be able to get away with that as a lending industry. You're going to be held to account for putting a borrower in a loan that they can't succeed in, and now
right,
it's the law.
right.
Yep.
So I found my what I was thinking about. University of Michigan came out. They said the 5-year probability of losing a job for upper income earners is at 24%, 24.3% in Q2. During the meltdown, the high was 23.6%. So we're at a higher rate at this point of probability that someone who's earning a lot of money is going to lose their job in the next 5 years. And since the upper end drives most of the consumption, and
Of
since
homes, yeah.
consumer spending is the 70% of GDP, it's something to watch. Brian, you look like you're
It'd be interesting to know like that data versus like, okay, you lose your job, but then you go to another job, or what's the lag time and what is the income
Well,
loss?
I can tell you from the conversation I just had, somebody was like, they said in 2020 they lost their job and they applied at different places and they immediately had just interview after interview after interview after interview, and they had a whole plethora of jobs to pick from. And they said this time it's like they look and there's nothing, like no
Yeah.
one's hiring, and it's just like, oh my God, what? How am I even get interviews? And oh, I'm probably gonna have to take a job that pays less because there's just nothing to pick from.
it.
Now I'm in the tech world, so there's a lot of tech jobs in my industry, but and it seems to be AI is just wiping them out.
I heard a statistic that 30% of programming can now be done by AI,
Mm-hmm.
which means, like
It's amazing.
programmers are much less in demand, I guess.
Yeah. And the original thing was they were comparing it to being like Google Translate. Oh, Google Translate didn't make translators go away. It actually enhanced their jobs and made them be able to be more productive. But AI seems to be getting rid of jobs.
Yeah, I mean, the question is, are there going to be other jobs created?
Yes.
Yeah, well, we would hope.
No, come on. Okay, this conversation has happened throughout history.
I
Okay, there
understand.
used to be people who would come and light the streetlights every night. They're gone. All right, there was
What? Well, wait a minute.
now
Buggy whip makers.
what?
Buggy whip makers.
Yes, I mean this is how it goes. So there is this transition period. It is not for naught. I mean, it is not, it'll be fine. It'll be
Well,
totally fine, but people have to be willing to transition and be flexible themselves.
I'll
So
tell you what, though, Audrey, I saw at the legal issues seminar, the MBA legal issues seminar, some interesting things happening in the mortgage banking world with AI, um, where companies are integrating AI into their process and maybe even changing their process. So, for example, you can have an AI generated letter that'll tell you all the things that you need to submit, tell a borrower all the things that they need from processing that, after they apply and then they need to follow up with all kinds of data. AI can just spit out a letter in, 1.5 seconds that would take a processor half an hour to put together. I mean, that's going to be some productivity gains that are going to be translated into fewer jobs and to maybe different processes, because maybe you can move some things further up in the chain, further up in the process. So I don't know. AI could have some, we're talking about 30% of programming. I mean, I don't know where it's going to end up for this business, but I think it's going to be significant.
Well, I'm just going to tell you that as a loan officer for the last 355 years, I've watched changes and I am not going to miss sending a freaking needs list to my client. I don't care. Like, I would much rather spend that time talking to them and learning something about them that is going to help figure out how to strategize their particular situation so that it is best for them. So there's a lot of mundane crap that, yeah, if AI can pick it up, knock yourself out. But remember that at the end of the day, unless every regulatory agency in the entire country blows up, I don't mean that in a literal sense, Jesus, that was not a threat, but unless they go away, we are held responsible with our licenses for whatever AI or a computer or spits out.
Same thing with legal work.
What?
Yeah.
Same thing with legal work.
Yep. So wait, so if you're filing a brief in court, you don't ask ChatGPT what cases to cite and then not check to see if they're real? You don't do that?
Okay, so this has happened to some lawyers.
I know. We talked about it on here. I thought that
Yeah,
was
no, that's
insane.
not good.
No, it's not
But I
good.
mean, ChatGPT can write things for you very well. I would say they're 85% solid, and then you got to fill in the details and the facts and make sure that it's not good with facts, but it's good with language.
Okay, so great. And actually, some of us are able to spot I mean, I think it's a good jumping off point for a lot of things. So, and then you tweak it and you make it your own, right?
Right.
And so it's a good resource, but you better be double, quadruple checking all of your data, everything it's doing. And because it somehow learns things. So for instance, the mortgage company whose AI system started denying every single plumber because some plumber had been delinquent on their loan at some point, and then it learned that plumbers were a bad credit risk. Or how about this system, the credit card, I think it was a credit card company that
It's interesting. You could probably discriminate against plumbers as long as you aren't discriminating against, like it's not a disparate impact or something. I
okay,
don't know.
you know what? Actually, disparate impact was on my
You can
list
just, you know
too.
what? You can discriminate against lawyers. How's that?
Well,
No,
There's
that's a great thing. I
like
don't work with lawyers. They're just
you
no.
you don't want to rent your extra bedroom to a lawyer. I discriminate against lawyers. I don't want any lawyers.
That's great to know, actually.
Knock
okay,
yourself out,
so I will
Kevin.
never forget. I was doing a loan for two attorneys one time, and I really liked them. They were great, but they were still attorneys. So we were setting up the time that they were going to sign their loan docs, and they wanted to see their documents before they signed them. So I got them a copy of them, and then we met the next day and we signed their loan documents. And I had blocked out, I am not joking, like the rest of the afternoon, and they were in and out in 45 minutes. And I told him, I said, okay, I really thought this was going to go down very differently. And what was that? Because it shouldn't have been that quick. And they said, it's boilerplate. You pointed out exactly what it said where, and we knew that the rest was fine. And so we're good. And so not all attorneys are a pain in the anyway, okay. Quickly.
Not like me, anyway.
Yeah, exactly. So I just want to say you have written on disparate impact quite extensively. And I just want to preface this by saying that you said, and I quote, I believe that intentional discrimination is both illegal and morally unacceptable. It seems trite and obvious to say, but for mortgage originators, illegal discrimination is more than simply bad for business, it's moronic. With that being said, you've also been really critical of CFPB for going after people for disparate impact or other things. So can you kind of quickly walk us through where we are now?
Yeah, well, it's an interesting place to be. The administration has taken a diametrically opposed position to what the prior administration had. The prior administration was very focused on equity, and viewed that if there was disparate impact that arose from lending decisions or from lending patterns, that was reflective of structural racism and therefore was reflective of intentional discrimination. This administration has taken the exact opposite view and has said none of that is important. What's important is you do not intentionally discriminate. And that, you know,
That's their attorneys.
well, that's what the executive orders say, right? But that's not legislation and that's not a court decision. So we still have the Supreme Court decision in inclusive communities, which was for 2015 decision, in which disparate impact was recognized as a potential measure of discrimination, but it was cabined to some particular facts and needs. But I think that was a 5-4 decision in a different era, in a different time. And I don't know what would happen to disparate impact as being evidence of intentional discrimination if it were to appear before the Supreme Court. I also don't think that there's any case right now that the government would bring that would be an actual challenge that was like contested, because, well, it may be on a state level because state laws may be different. And the question is that constitutional in light of the Harvard admissions case, which basically says you're not allowed to take race into into your decisioning, unless it's specifically to address a specific past discrimination issue. So there's a lot of legal issues there. I think disparate impact is on life support at best. But, should we get a new administration with the similar view as the Biden administration, it could be game on all over again. So I'm staying tuned.
But in no way is anyone condoning any sort of discrimination. So that definitely has not gone away at all.
No. I mean, and that was the point about intentional discrimination is it's illegal and moronic.
Yeah.
Like, why would you
Exactly.
why would you discriminate against people, that could be successful home buyers?
Ridiculous. Okay.
Those are your clients. That's your business.
On that bright note, we are
Way over time.
If you want to watch any other episodes from the past, you can find us on our Mortgage Pros 411 YouTube channel or on the Crispin Commentary website. And Brian, we thank you as always for your brilliant thoughts and insight. Thank you for being here.
And
my pleasure.
Where would people find Brian?
Yeah, if you folks want to read the rest of that post I had on disparate impact, you can go to Substack and search me out, Levy's Mortgage Musings, and you can read that and the last 90 or so posts that I put over the last 6 years.
92 last I checked, I think. And also make sure you
92.
read his footnotes because they're in there. And yeah. Anyway, all right, kids, have a great week. Go get a loan. They're out there. We just have to find them and work hard to close them. All right, bye.
Thanks, Audrey. Thanks, Kevin.